9th, oil prices look like trading in Asia a little bit soft, and looking at a second week of declines, which would, would have seemed a little bit unexpected, let's just say, at the beginning of the week, as we came out of last weekend with the announcement of further tightening, cutting by the OPEC countries, well, particularly by one country, Saudi Arabia, signaling further cuts next month. But that had little impact on the oil markets. But nonetheless, we've seen equity markets soar this week while oil markets decline. The S&P 500 hit a bull market yesterday, which is defined by up 20% from the low last October. So equity markets see a much brighter future, it would appear, than oil markets do. Edward Bell, head of market economics at Emirates MBD, you're paid big bucks to explain this to clients every day. Why are equities going through the roof and oil are falling down?
Yeah, that's a great question. I think it's a great observation. I'm sure all of us are sick to death of hearing about the disconnect between fundamentals and the narrative of the macro story in oil markets. I think we've had the equity markets and financial markets generally are fixated much more on what's happening with the Fed next week, and indeed in July as well. It had sort of swung from this year being the one where the Fed was going to have to call quits on tightening policy and move to cuts before the end of this year. Even a couple of months ago, markets were pricing in cuts in rates as early as July. We had swung the opposite way as the data continued to come in quite strong from the US. However, you wanted to slice it, the labor market, the services sector, yes, it's showing signs of slowing down, but not showing signs really of any kind of imminent collapse or recessionary kind of conditions in the US. And now we've had some signs just last night that labor data coming in a little bit soft, the initial jobless claims going to their highest levels since 2021, since midway through 2021. And that's, I think, tempering further the expectation that the Fed would need to do additional monetary tightening in the upcoming meeting. So all of that is sort of music to the ears of equity markets. I think for the oil story, it is focused that's part of the ingredient mix, but I think also there is a lot of negativity coming around the interpretation of data, at least coming out from China. So the export and import numbers we had this week, there were some positive signs around the commodity import numbers, but overall some signs of general slowdown in activity, or just at least China not coming in as strongly as markets had been wanting. But we could switch in the next couple of weeks. We will have the PBOC setting policy rates, expectations that they could be actually cutting those to help support activity in the real estate sector, which could be another sort of swing upwards from the macro story for oil to push higher.
Mark Howson, head of Asia, Welligence Analytics. Mark, if oil seems to be not listening to the equity sing-song, gas seems to be tone deaf to any optimistic outlook as gas prices continue to decline, and Europe are sort of back in business. Your thoughts of the disconnect between gas and equities?
Yeah, that's exactly right, Sean. I mean, gas is an interesting one, but particularly the LNG market, which sets the global gas prices on the margin in various regions of the world, including Europe and Asia as well. And what we expected in terms of supply has actually incurred. So there hasn't been much new global gas supply. Typically, the global LNG market grows by around about 5% per annum, and certainly for the last 3 years, we've had growth at under 3% per annum on the supply side. And for the next couple of years, this year, next year, and to the beginning of 2025, that growth continues to be very, very muted on the supply side. But what has quite frankly shocked the market is how muted it, as Ed touched on, but in the big gas LNG consuming nations, and Ed touched on China quite rightly, how demand there's been a lot weaker than we were expecting this year. Chinese LNG demand did continue to fall by about 2% in the first quarter of this year. So that much reduced Chinese demand, partly as a result of higher piped imports for them from their neighbors like Russia, but also higher domestic production. has come at the same time as as you know, pretty mild winter in the Northern Hemisphere, particularly Europe, which means that European gas inventories are now sitting at around 70% full, which is far higher than the typical averages at this time of year, which are kind of between 50 and 55%. So just a number of bearish factors hitting the market this year on the demand side, and that's really why we're seeing these gas LNG prices fall away, Sean.
Let's welcome Gilmira Raza, founder and managing director of Eurasia Analytics. Gilmira, I wanted to get your thoughts. I mean, we've got this disconnect, it would appear it's on some level between the equities and the energy markets, oil and gas, as equities see a very positive outlook, but the war in Ukraine obviously is a very big factor in the sentiment of everything. And increasingly, we are seeing more reporting about the outlook, the more permanent outlook for the change in energy flows. And that's where I wanted to get your commentary this morning. We're seeing increasing reporting about where will Russia find a new home for its gas that is now pretty much removed from the European market, still obviously moving there through pipeline in certain ways, but ultimately on a very serious downward trend. And the new outlook for Russian gas seems to be in Central Asia through to China. Your thoughts on that sort of, a permanent redirection of Russian gas, what it means for Central Asian gas producers? Is that a viable outlook over the medium term?
Well, yes, indeed, we have a paradigm shift, and not only in the European natural gas market, but I would say now in most parts of the world, and including actually also Central Asia and Asia. So since Europe doesn't want to take any Russian gas anymore, so this huge volumes of gas has to go to somewhere, and there is no market at the moment that could, substitute the European market, and there is no market that could buy as much gas as Europe, has been buying so far. Well, you asked about Central Asia.
Yeah, would Central Asia facilitate that? Because inevitably a lot of that territory has to facilitate those transport pipelines and so forth.
First of all, Russia considers Central Asia as some of those countries, for instance, Uzbekistan and Kazakhstan, as a kind of a potential market for its gas, especially high, demand periods in winter time. And secondly, yes, it's for Russia, for Gazprom, it's a good transit country, having especially again Uzbekistan, Turkmenistan, and Kazakhstan having infrastructure in place which connects these countries to China. The thing is that the Gazprom's strategy, which has been actually the company's policy for many years now, it's not only to use the infrastructure as or countries as a transit country to export its gas to China, but Gazprom wants to control that infrastructure, that pipelines that are passing through those countries. This is something that obviously Central Asian countries would not want, and I think the stumbling stone is just there because they would not want to give up their infrastructure, let Gazprom to control it. It would mean for them strategic, financial, economic losses, and I don't think that they would go for that. But again, speaking about China as a market which can replace the European market, I mean, I don't see this possibility that Russia would be able to export large amount of gas to China anytime soon. In the following years.
Well, it's obviously takes a while to build that kind of infrastructure unless you have a massive LNG capability. But Ed, I wanted to come back to this question of where does the current profile of the oil markets leave the Gulf states in their fiscal position, particularly Saudi Arabia, which of course, as we know, has a very, very significant economic reform program underway with massive commitments to expenditure in the developments of the likes of NEOM and otherwise. where does this current price trajectory, I mean, whether you keep 75 to 80 and you have to keep cutting, either way you seem to be in a losing wicket. $80 seems to be the balanced budget number for the Saudis. Where is the fiscal posture of the Gulf states, and particularly Saudi Arabia, on the current trajectory of oil prices for 23?
Yeah, it's a good question. We're digging through this as we speak right now, because I think when we look at the oil story for the GCC, you know, this year is the mirror image of what we had in 2022, where it's really going to be a drag on headline growth in 2023 and probably in 2024 as well, or not really going to be adding a material boost to activity. And it's the trade-off that I think the countries within the GCC are trying to make, is how much can we cut to benefit from a higher price, and how much is too much. And I think it is a question of Saudi Arabia producing 9 million barrels a day in July, and we expect that they're probably going to keep at those tight levels for much of the rest of the year to try and help set a floor under prices. It's not really a story that's positive for the fiscal balances, I think, of the GCC region. So we're probably going to be running much closer to balanced or deficit budgets across the region this year. As you say, that's not really conducive, I think, to funding a lot of the long-term projects that the kingdom has in place, or indeed many of the other GCC economies have on track as well. But I think to say that, okay, well, we cut production on Sunday, and we haven't had the oil price rally to $100 a barrel by the following Friday, I don't think that's the kind of time frame that Saudi Arabia was probably working towards in terms of the effects of these cuts. So they want to see.
But clearly, this is not the first cut, and it wasn't even a cut. It was an announcement for next month. But yeah, this we've had a cut in October. We had a cut announced unilaterally in April for May starting, and now we've had another cut for July.
This is the big debate, right? I mean, is this a strategy? If you're having to chop and change it every couple of months, one could argue that not really. You're just responding almost like an oil trading desk at a hedge fund saying, well, we see a near-term opportunity for us right now, so we're going to adopt this kind of position or that kind of a position. So chopping in and out of the market with these big volumes, I think is going to lead to a very choppy fiscal profile for the region as a result. But I think long run, there's two dynamics working sort of in collaboration with each other. One is, okay, we want to set a floor under oil prices so that, you know, $75 is, for instance, the base, and anything on top of that is sort of quite beneficial or additive to the fiscal positions of the Gulf economies. But that at the same time, you carry on the reforms in the non-oil sector, so you help to improve your fiscal governance or your fiscal capture in those parts of the economy as well. So you're getting the benefit of the oil income, regardless of the price, as well as carrying on the momentum in the non-oil space. And we see that really as being the driver for growth going forward. Yes, oil is certainly important for the Gulf economies, but if you look at the non-oil sector in Saudi Arabia right now, it's really quite strong. So we actually had our own projections this year for coming in at about 5% non-oil activity in the kingdom. We think that's actually probably too conservative at this point in the year. So the non-oil story looks to be streaming well ahead on its own steam. Yes, it gets the benefit or the sort of sugar rush or the addition of support from the oil.
I think the new phrase is lollipop. I'm not sure if it applies to everything. But,
I don't want to use that. Yeah,
Mark,
to resist.
Mark, I wanted to get your thoughts on where is LNG globally at the moment. I was in some meetings in Oman last week, and they were just like, whew, we got our deal done on the Oman LNG renewal before the prices fell, and we got everybody locked into some great deals for us, i.e. Oman. The Chinese the data overnight that factory deflation prices, factory gate prices fell at the fastest pace in 7 years. It's not exactly the sort of optimistic outlook only a few months from the peaks of investing, for those who might be interested, billions of dollars in new LNG capacity. Your thoughts of where the big picture is now after we've been up this massive mountain and now we're coming down the other side with some big renewals coming up in the coming years with the likes of Qatar.
Yeah, absolutely, Sean. I think the other bearish factor that we haven't touched on is Japan. Japan, obviously the world's biggest LNG importer, and their imports were down over 5% in the first quarter of this year.
But yet their economy seems to be doing well. I mean, the macro numbers out of Japan seem to be somewhat positive.
Exactly.
So a strange story today about on Bloomberg, Tokyo residents have been urged to conserve power to avoid shortages. That's a bit shocking to see that headline.
Yes, but again, post kind of Fukushima, there were kind of similar measures put in place, and the Japanese people came together and did that, Sean. The other big factor there, Sean, is the nuclear plants are now starting to come back online, because obviously a lot of them were already built but kind of taken offline after Fukushima. So now they are coming back online, and that again is just kind of squeezing their LNG demand this year and for the remainder of it as well. In terms of bright sparks, because like you say, there are a number of negotiations ongoing. You probably saw the Qatari deal announced last week for Bangladesh, and that was a kind of long-term oil price linked deal as we understand it. And that, to us, is very indicative of where the next tranche of real LNG demand is coming from. We've spoken about weaknesses in the big gas markets of Japan, China, Europe, but if you look at emerging Asia, Sean, particularly Southeast Asia and particularly South Asia, that Indian subcontinent region, they don't have a huge amount of alternatives to LNG usage aside from coal, and that's obviously challenged from an ESG perspective. But if you look at the domestic gas production in a lot of these countries, Philippines, Bangladesh, Vietnam, for example, it's very either plateauing or falling, whereas obviously the economies are fast growing, so that they are facing power outages and power cuts as well. And that's why there are 3 countries now that are going to begin importing LNG for the first time in the next month or so: Philippines, Vietnam, and Hong Kong. And those are the types of markets where we see the next kind of tranche of demand coming from.
Gilmira, what does this mean for Azerbaijan? Obviously, that is your country and where you have your deep experience and exposure. We saw over the last few days BP urging patience over their deep offshore gas prospects there. Are BP going on the slow motion now because prices have dropped off? What's the impact for the likes of Azerbaijan, which obviously saw Europe as a big new opportunity?
Well, it is indeed. There's a great opportunity for Azerbaijan to start exporting more. I mean, in fact, doubling the gas export volumes to Europe by 2027. Currently, it's exporting 10 BCM, but according to MOU signed between Azerbaijan and the EU, so the country will start exporting 20 BCM from 2027. And indeed, it's a good investment opportunity in the country, and expanding its country markets in Europe. But as you correctly mentioned, there are many concerns, and one of them is gas prices that are softening now, and most likely we won't see that high, historic high prices we've seen in previous months. And that obviously put a lot of question in front of investors and energy majors that are developing these upstream projects in the country, whether it was to go ahead with multi-billion investment in those fields. But many things will depend on the demand side, of course. If there is enough demand, and that will show the market test of the Trans-Adriatic pipeline, that's the European part of the value chain. So market test will show how much demand is there at the moment, and if the European buyers, the companies, potential buyers would want to buy 10 BCM of gas from starting from a certain period of time, and whether there is a long-term contracts for this gas, whether they are willing to conclude long-term contract, so to give the purchase guarantee to the government and to the investors that in the country. I mean, this is a very complicated process because it links the market with the upstreams, and it's quite complicated all along.
But you had already been saying and expecting that the Europeans were being unrealistic last year, obviously, when the height of the energy security issue was present, prices were going through the roof. Europe wasn't indicating a willingness for long-term supply agreements, and that was a disincentive for the likes of Azerbaijan to develop. That now seems even more remote, that Europe, given this price correction, will commit to anything maybe beyond 5 years.
Yes, that's true. Even when the prices were very high, I mean, if the gas sellers talking about minimum 15 years of long-term contract, obviously the European buyers wouldn't want to commit themselves to that long-term contracts, because most of those countries are pledged for net zero, beyond 2040 or 2050, but this complicates getting a financial support from international financial institutions and banks, because they would require exactly this, supply security, demand security from the government of Azerbaijan, from state oil company, which needs to be presented in order to be able to get funding for all those multi-billion projects. So as I said, it's quite complicated and tied with, interlinked, all the with upstream with midstream and market.
Of course. Let's go to the survey question, which touches on the theme of what we were starting out with today. Stock markets soaring as oil markets falling. Which one has correct outlook for the global economy? Oil markets or equity markets? It's a bit black and white, obviously, in the question, and there's probably 5 other answers one could put there. But take your pick on this particular optionality. Ed, I wanted to come back to you because the other big news of last weekend, which of course got a little bit smothered by the sort of bionic headline that media likes to jump on, obviously 1 million barrel a day cut by Saudi, which is next month, and it's only for a month, and if you average it annually, it's less than 100,000 barrels a day, so it's hardly going to move the needle on just 1 month commitment. But the other commitment that OPEC Plus made, which was more long term, was the reformatting of the quotas, which is the production level that each country enjoys or is expected to comply with. One of the countries that wasn't mentioned, and I'm wondering if it is where the two things come together, which is the front month cut by Saudi and the wider sort of quotas, is Iran, because it does appear that the OPEC Plus, OPEC, whatever way you want to cut it, has to make allowances for the return of one of their biggest producers. And they've kind of been enjoying, if that's the right word, a full sense of parameters over the last few years. And now things are changing. Even Venezuela seems to be having a lifeline again, with the Americans and Chevron back in action there. Your thoughts of where those two intersect, the return of the sort of renegade OPEC members and their production and supply capacity with the existing?
Yeah, I think during the press conference, there was a comment from the Saudi energy minister that alluded to that, to countries that were, I think he had a phrase that sort of countries that currently have issues, basically, referring to Libya, given the kind of geopolitical crisis that has affected production there in the last several years, but also Venezuela and Iran, and how they could be basically welcomed back into participating in the OPEC Plus agreement if they are free of sanctions. And I think we have seen commentary in the past from the Iranian energy ministers that would support that. Yes, they would like to engage with OPEC Plus and be a committed partner. I guess it is a bit of a gamble, though, on the part of OPEC Plus that a full deal is not in the offing right now between the United States and Iran that would see the resumption of sanctions-free trade in Iranian oil.
But it would seem, regardless, that Iran is exporting pretty much as much oil as they can.
Indeed, yes. The trend line has been moving higher with Iranian production. I think that's actually quite welcome that you have those sources of supply coming from countries like Iran, coming from Venezuela, given that we subscribe to the view that we are going to be in a pretty tight market in the second half of the year, and those additional barrels, I'm not I wouldn't say that we would feel comfortable that Iran could increase production in the next 6 months by, say, 500,000 barrels a day without a relief on the sanctions, but that it can trend higher, maybe an additional 100 or 200,000 barrels a day or so. So I think that would certainly be welcome to help alleviate a real surge in energy price inflation in the global economy. But I think that seat is still very much open, that when the sanctions are lifted, if there is a deal that alludes to that, then Iran participates fully with a quota as part of the OPEC plus cuts. I think kind of more interesting, another interesting dynamic, I think there's a lot of focus on the kind of UAE Saudi dynamics and the rebalancing of quotas for 2024, is what Saudi wants to do about Iraq as well, as a long-term potential, not competitor, but another country that has a very big upside potential in terms of capacity upgrades. So I think for both UAE and Iraq, those are really the two big countries to keep sort of on side with Saudi Arabia, to make sure that they are all getting what they need out of the OPEC plus alliance.
Well, it strikes me that it's only the beginning of this conversation. The 200,000 extra production capacity that the UAE got is on top of whatever little bit they got. Was it last year or the year before? Now the years are blending, but ultimately this is an ongoing narrative of, you know, the UAE seeking more production capacity, and as you mentioned, Iraq has already got that. But they were all hoping that with the return of Iran and Venezuela, whenever that day would arrive, that it would come at a time when the global market was growing, was in there's room for everybody kind of scenario. And that big question lies in Asia, Mark, this year. Are you still subscribing to the year of two halves, and that China and Asia will turn up the demand taps in the second half of the year, and there will be room for all this oil that these oil producers want to sell?
Yeah, I mean, certainly, Sean. I'm quite focused on the gas side, and that's certainly what
I'm sure it's the same. It's even more relevant on gas. I mean, will there be economic growth in Asia sufficient to consume the amount of gas to power the generations? I mean, China may be suffering blackouts this summer as well. So is the economic sort of growth path of Asia, of China, I mean, it's been articulated since January, since December when they reopened, that this was going to be a year of two halves, and that the second half would deliver the bumper demand outlook, whether it be any commodity you want to choose, whether it be, corn or oil or gas.
Yeah, but I guess the seasonality is the big difference, right, between the gas and the oil markets. Typically, as the gas markets, as you get closer and closer to those winter months, you do see a particularly high spike, particularly in Asia, because the big importers are typically northern hemisphere. And then again, on the supply side, the supply is a lot less elastic, reactive on the gas side, because it can take up to 5 years to build the terminals, and there's not just kind of a balancer in the market to quickly ramp up and down production in a shorter term manner. But yeah, I guess to answer your question, I mean, we certainly see demand coming back, but again, less likely to be those.
Well, give us that picture of where China LNG imports were at a year ago, where they're looking to be at this year.
Well, to be honest, last year they fell quite dramatically.
Exactly.
Yeah, which surprised us all, right? I mean,
would we expect to get back to pre-COVID levels this year? What was it, 60 million tons or something?
Not all the way back, Sean. Not all the way back. We are going to see some growth this year. As I say, first quarter we went down 2%, but yeah, we certainly expect overall a modest amount of growth from China, but really kind of more growth coming from, as I say, those South Asian and Southeast Asian markets.
Well, you would imagine if the gas is only modest growth, then you're not thinking, it wouldn't seem to equate with a bumper economic performance of China, which is targeting a 5% growth this year. Let's wrap up with Gilmira. Gilmira, I wanted to, with the survey result, Gilmira, to get so oil markets have it right, equity markets are drinking the Kool-Aid as always. Gilmira, I wanted to get your thoughts on the terrible war in the Ukraine, Russia's sort of escalation, and the sort of counter, the scale of the terrible events this week of the destruction of the dam. From a Central Asian perspective, does this look like it's getting any scarier? Is it, it looks like it's bedding in for a long time? What's the ramifications of the sentiment in the likes of Azerbaijan and Central Asia regarding this ongoing conflict and what now appears to be some level of escalation?
Well, in geopolitical terms, it's obviously that the war in Ukraine affects the region, the South Caucasus region, Caspian region, Central Asia countries, because I think that Russia is losing its grip on those countries. Well, as far as Azerbaijan is concerned, I think it already doesn't have much influence in this country, and that's happening, you know, as first time ever since 19th century. So it's historic events actually happening in this region.
Would that be welcomed by the region?
I think yes, because well, the regional countries, they want to pursue their independent foreign and energy policy. Well, Azerbaijan probably is the only country which managed to, you know, untap the Caspian resources and start exporting oil and gas to Western markets. But we can't say the same about the Central Asia countries and, you know, other South Caucasus countries. So yeah, a lot of things is changing, and I think that we're going to see less Russian influence in the region in next years, and perhaps activation of countries like Turkey, and perhaps, you know, the Western countries, Europe, etc.
What, just finally, the re-election of Erdogan into Turkey, now his in the next 5 years as president, how would that be viewed in Central Asia and Azerbaijan?
Well, you may know that there was kind of it was a big event for Azerbaijan and Central Asia countries. People were celebrating Erdogan's re-election, because that's what these countries wanted to see, you know, a victory of Erdogan, because, you know, Turkey, I mean, first of all, these countries are Turkic countries, and, you know, Turkey has great plans for this region, its integration plans, you know, connection of Central Asia with Europe, with this so-called middle corridor, and China as well, through this region, and Turkey will play an important role. With Azerbaijan, with Zangezur corridor, which is still, you know, unresolved, but I think will be resolved anytime soon. So there is a big plans, big hopes that the region will be involved in all these, you know, major project, transportation and energy project, and Turkey, as I said, will play a crucial role, because, you know, Erdogan is indeed a strong man who can pursue very big global projects in this region.
Okay, well, we'll have to wrap it up there. Fascinating stuff always in Central Asia. Brent crude oil trading down 0.5% at $75.60. We thank our panelists today, Mark Howson with Wellington's Analytics in Singapore, Gilmira Raza in London, and Edward Bell in Dubai with Emirates MBD. Thank you very much for your insights today, and have a great weekend, everybody. We'll be back Monday morning, 10:30 a.m. UAE time. All the best. Thank you.
Thanks, Sean.